Long-lived assets, end of chapter questions. Question number 1. Jovi Incorporated has recently purchased and installed a new machine for its manufacturing plant. The company incurred the following costs: purchase price, freight and insurance, installation, testing, and maintenance staff training cost. The total cost of the machine to be shown on Jovi's balance sheet is closest to what? Purchase price to be capitalized. Freight and insurance is essential to bring the asset in working condition, to be capitalized. Installation essential. Testing essential. But the training cost for that staff member, those staff members who will be involved in maintenance once the machine starts working, this is not something that we should capitalize. So these are the 4 costs that must be added as the initial recognition amount of the asset. So adding all these, 12,980, 1,200 and 700 and 100 gives you a total of 14,980, and that makes B to be the correct option. Next, which costs incurred with the purchase of property and equipment are expensed? Delivery charges, it is capitalized. Installation and testing, capitalized. Training required to use the property, plant and equipment, this is not a part of the property, plant and equipment. It is expensed when incurred. C is expensed when incurred. Next, when constructing an asset for sale, remember, constructing an asset for sale, not for use. Directly related borrowing costs, the interest expense, are most likely to be done what? Expenses incurred. Since the asset is being constructed, this asset is for the purpose of sale, so not expenses incurred. Be capitalized as a part of inventory. Why? Because this asset is being constructed for sale, it's an inventory. So interest cost for such an asset would be capitalized as a part of inventory. That's the right option. Why not C? Capitalized as a part of property, plant and equipment. Normally we do, but since this asset is specifically for sale, not for property, plant and equipment, so this would be the incorrect option. Right? Company normally, when an asset is constructed, the interest cost incurred, it is added to the cost. It is generally capitalized. But since this asset is for sale, not as a property, plant and equipment, so this option is wrong. So that makes B to be our correct option. Next, Baru, a Brazilian corporation, borrows capital from a local bank to finance the construction of its manufacturing plant. Now this is a property, plant and equipment item. The loan has the following conditions. The borrowing date is 1st January 2019. Amount borrowed 500 million Brazilian real. Interest cost is 14%. Total term of the loan 3 years. Annual payment of interest only. Principal amortization is due at the end of the loan. Means you just have to pay the interest. The principal part will be paid at the end of the loan term. Okay, now interesting question. The construction of the plant takes 2 years, during which time the Baru earned 10 million by temporarily investing the loan proceeds. I just said a little while earlier, if you get a loan from the bank or financial institution for constructing an asset, and the sum of the loan's amount, or maybe the whole of it, is invested in temporary investments, and if you generate some earnings out of it, that part must be netted off against the interest cost, and the net amount must be capitalized. We'll calculate. So which of the following is the amount of interest related to the plant construction that can be capitalized in Baru's balance sheet? First of all, the loan amount is 500 million Brazilian reals. Interest rate is 14%. And since the loan has been due for 2 years, the interest expense total will be 500 times 14% times 2. That's 140 million. Since we earned 10 million interest or 10 million earnings out of the funds available by investing the surplus funds in some marketable securities, this 10 million must be netted off against the interest, and only 130 million Brazilian real can be capitalized. So that makes A to be the correct option. Next, after reading the financial statements and footnotes of a company that follows IFRS, an analyst identified the following intangible assets: product patents expiring in 40 years, Copyright with no expiration, so it means this is an intangible with indefinite life. Goodwill acquired 2 years ago in a business combination. Which of these assets is an intangible asset with finite useful life, limited life? Only the patent expiring in 40 years. Copyright with no expiration date is not an intangible with finite life, and goodwill is impaired. It is not considered among those assets with finite life. So it means the only first element, product patent yes, copyright no, goodwill no. So it's going to be yes, no, no. That makes B to be the correct option. Intangible assets with the finite useful life mostly differ from intangible assets with infinite useful life with respect to accounting treatment of what? Let us discuss these one by one. Intangible assets with finite useful life, they are amortized. Intangible assets with infinite life, they are impaired. Revaluation is irrelevant for these. So intangible assets with finite useful life mostly differ from intangible assets with infinite useful life with respect to accounting treatment of amortization. This is the distinguishing feature of intangible assets with limited life, that they are amortized over the lower of their useful life or legal life, whichever is lower. So that makes C to be the correct option. Costs incurred for intangible assets are generally expensed when they are internally developed. Yes, internally developed intangible costs, like any research and development cost to acquire some new knowledge and developing it into a viable product, all the costs incurred for such an intangible is expense was incurred. But when an intangible is individually acquired, or when an intangible arises due to a business combination, this is goodwill, these two are separately accounted for as an asset. So costs incurred for intangible assets are generally expensed when they are internally developed, whereas individually acquired are capitalized, and goodwill arising or business combination, it is also an intangible capitalized as an intangible asset. So B and C are assets, intangible, whereas A is expensed, and that makes A to be the correct option. Under US GAAP, when assets are acquired in a business combination, goodwill most likely arises from what? Goodwill arises when we purchase a business with the fair value of net assets at the acquisition date of $70,000 and we pay a consideration of $150,000. This is what we paid to acquire 100% equity in a company by paying $150,000, and at that date of acquisition the fair value of net asset was $70,000. So the difference between these two is called goodwill. So under the US GAAP, when assets are acquired in a business combination, goodwill mostly arises when contractual or legal rights is an intangible other than goodwill. Goodwill arises on business combination. A is wrong. Assets that can be separated from acquired company. If the asset can be separated from acquired company, it's not goodwill. Goodwill is a part of business acquisition. B is wrong too. Assets that are neither tangible nor identifiable, they are a part of the business acquisition. This is the correct description of goodwill. That makes C to be the correct option. All else equal, in fiscal year when long-lived equipment is purchased, what happens? Depreciation expense increases. When you will purchase a long-lived asset, you will have to depreciate it. So acquiring a long-lived asset will involve depreciation, so depreciation expense will increase. This is true. Why not B? Cash from operation decreases. No. Cash flow from operations would increase because of depreciation charge. Rather, cash flow from investment will decrease because acquiring a long-lived equipment, it's an investing outflow. So cash flow from investment will decrease, not operation. Wrong option. Net income is reduced by the amount of the purchase. No. Net income will be reduced by depreciation, not the purchase. C is wrong as well, so that makes A to be the correct option. This is a good one. Good question indeed. Companies X and Z have the same beginning of the year book value of equity and same tax rates. Equity is same, tax rate is same. The companies have identical transactions throughout the year and report all transactions similarly except for one. And what is that difference? Both companies acquire a pound $300,000 printer with 3 years useful life and a salvage value of £0. On January 1st of the new year, Company X capitalizes the printer and depreciates it on a straight line basis, £300 million with zero salvage value, split over 3 years on equal installment basis, means every year depreciation will be £100,000. Okay. Company Z expenses the printer, the whole of it. The whole of £300,000 has been expensed by Company Z. Okay. The following year-end information is gathered for Company X, the company that depreciated this printer. Ending shareholders' equity for Company X, 10 million. Tax rate 25, which is same for both. Dividends, Mafi. Net income for Company X is £750,000. What do we need? Based on the information given, Company Z's return on equity using the year-end equity will be closest to Company Z. Since we have been given data for Company X, we have to use this data and extract the relevant data for Company Z to calculate the return on closing equity. Let us write the data down side by side for X and Z. What we know for sure, that X charged this machine as a depreciable asset and charged depreciation over 3 years, which means the annual charge was £100,000, whereas Z charged the whole of this £300,000 as an expense, meaning thereby that Z charged £200,000 more. In other words, Z's income will be lowered by X by £200,000. Since we are talking about the net income, so we have to take in account the impact of tax as well. This $200,000 expense has to be taken after tax. So in order to convert into after tax, we'll have to multiply it with 1 minus tax rate, which is 25%. That is 75% of 200,000, that is 150. It means the net charge against this net income would be 150. This $750,000 is the income reported by X. We cannot deduct $200,000. Why? Because this £750,000, it is net income. So if you want to deduct this $200,000 of expense pounds, we have to deduct it after tax basis. So after tax basis will be 150. So deducting this £150,000 from X net income will give us £600,000 net income reported by Z. Now we need to calculate return on equity, and return on closing equity says is equal to net income upon equity. So net income is £600,000. Equity for X is 10 million. X equity and Z equity would vary by this amount. If equity X is 10 million, the equity of Z would be lower by £150,000 because this is the difference between these two companies' net income. So deducting this 10 million from deducting £150,000 from 10 million will give you 9,850,000. Calculating now the return on closing balance of equity, 600,000 upon 9.85 million gives you 6.1%. That is option B. Next, a financial analyst is studying the income statement effect of two alternative depreciation methods for recently acquired piece of equipment. She gathers the following information about the equipment's expected production life and the use. Production in units 2000 year 1, 2, 3, 4, 5, and in total this is what the asset is expected to produce in 5 years life. Okay, compared with the units of production method of depreciation, if the company uses straight line depreciation method to depreciate the equipment, its net income in year 1 will most likely be higher or lower. Now this is interesting. We have two systems of depreciation side by side. One is the unit of production method and other is the straight line method. We can't compare these two directly. We have to convert them in percentages, only then we'll know. Since the asset has 5 years life, which means under straight line method depreciation charge each year will be 20%. But for unit of production method depreciation will change depending upon the number of units produced. Since in the first year, we're talking about year 1 only. In year 1, we produce 2000 units, so we will produce 2000 units. So these 2000 units will be what percentage of the total expected production? 2000 upon 10,500 multiplied by 100. This will give you 2000 upon 10,500 times 100, 19.05. Now, this will result in higher depreciation, lower net income. Unit of production method will result in lower depreciation, hence higher net income. So the question said, if the company uses the straight line method to depreciate the equipment, its net income in year 1 will most likely be lower because the depreciation charge is higher. So that makes A to be the correct option. And A it is. Next, a company purchases a piece of equipment for 1500 euros. The equipment is expected to have a useful life of 5 years and no residual value. In the first year of use, the units of production are expected to be 15%. 15% of the equipment's limited lifetime production capacity. And the equipment is expected to generate 1500 of revenue and incur 500 of cash expenses. Right? The depreciation method yielding the lowest operating profit. That method will give you the lowest operating profit that results in the highest depreciation in the first year of use. First of all, this asset is expected to last 5 years. So under straight line method, 1 upon 5 means depreciation percentage will be 20%. Under units of production method, he has given you the percentage, that is 15%. And under the double declining balance method, which is in fact is the double of the straight line percentage, that will be 40%. Since we needed the lowest operating profit, and that will come in case the depreciation percentage is the highest, which in case is the double declining balance method. So when you have a higher depreciation rate, the depreciation expense will be higher. Resultantly, double declining balance method will give you the highest depreciation, thereby lowest operating profit in the first year. So that makes C to be the correct option. Next, John Martinez, CFO of Women, is selecting the depreciation method to use for a new machine. The machine has an expected useful life of 6 years. Production is expected to be relatively low initially, but to increase over time. Okay. The method chosen for tax reporting must be the same as method used for financial reporting. If Martinez wants to minimize tax payments, we want to minimize our tax payments in the first year of machine's life. Which of the following depreciation method is Martinez most likely to use? If you want to pay less tax, for that your profit must be low. If you want to have low net profit, then your depreciation must be high. So which of these methods will give you the highest depreciation? The double declining balance method. This method will give you the highest depreciation in the first year, in the early period, first year of machine life. So without doubt, like in the previous question, double declining balance was 40%. So in this case, double declining balance method will result in the highest depreciation, lowest net profit, hence the lowest tax. That makes C to be the correct option. Now, Miguel Rodriguez of Mario Uruguayan Corporation is computing the depreciation expense of a piece of machinery for the fiscal year ended 31st December 2009. The equipment was acquired on 1st of January 2009. Rodriguez gathers the following information: currency in the Uruguayan pesos, cost of equipment 1.2 million, estimated residual value 200,000, estimated life, total productive capacity, production expected in the fiscal or financial year 2009, expected production for the next 7 years, 95,000 units each year. What are we required to calculate? If Mario uses straight line method, the amount of depreciation expense on Mario's income statement related to manufacturing equipment is closest to. Straight line depreciation is calculated using this formula: cost 1.2 million, that is cost minus residual value upon estimated life. Cost is 1.2 million, estimated life is 0.2 million, divided by estimated residual value is 0.2 million and estimated life is 8 years. So if you calculate 1.2 less 0.2 upon 8, it gives you $125,000. $125,000 per year. This is the annual depreciation under the straight line method, and it matches with your option A. A is the right answer. Next, same question, but this time you need something else. It says if Mario uses units of production method, the amount of depreciation expense on Mario's income statement related to the manufacturing equipment is closest to. Coming back to this information, depreciation under units of production method is the number of units produced in the first year, 135, divided by the total output capacity. Expected production for the next 7 years, 95,000 multiplied by 7 plus 135, which is the production in the first year. This is the total productive capacity of the machine. 95 times 7 plus 135. It gives you a total output expected from this machine of $800,000. So out of this 800,000 units, we have produced 135. So for this we need depreciable base. What is depreciable base? Cost 1.2 million minus residual value 0.2. So 1.2 minus 0.2, that's 1 million. So 1 million multiplied by 135,000 units upon 800,000 units, its simplification gives you 168,750. This would be the depreciation, whatever the currency is, for the first year or the year 2009. That makes B to be the correct option. Which of the following amortization methods is most likely to evenly distribute the cost of the intangible asset over its useful life? Intangible asset is to be amortized, and we want to use a method that will evenly distribute the amortizable base. Straight line method charges equal depreciation every year. Units of output is variable. If you produce more units, more depreciation. Less units, less depreciation, less amortization. So it's variable depending upon the usage, right? Double declining balance method will result higher depreciation in the early periods and the lower depreciation in the later periods, or something like this. Since we want to evenly distribute the amortization expense of the intangible assets, so we will go for straight line method, and that is clearly A to be the right answer. 17. Which of the following will cause a company to show a lower amount of amortization of intangible assets in the first year after acquisition? Higher residual value. If your residual value is higher, it means your depreciable base, because depreciable base is equal to cost minus residual value. If you have high residual value, it means the overall depreciable base will be lower. So having a low depreciable base means your depreciation expense would be low. When the depreciation expense would be low, that will fit the bill. Which of the following will cause a company to show a lower amount of amortization of intangible asset in the first year after acquisition if there is a high residual value? Without doubt, this is the right option, but it is always advisable to see the other options also to convince yourself that you have done it correctly. Higher amortization rate will result in more depreciation. A shorter useful life means you have to split the amortizable base on a shorter period, resultantly depreciation or amortization would be higher. So B and C will result in higher amortization, but A would result in lower, so that is our right answer. All right, next. A company purchases equipment for $200,000 with 5 years useful life and salvage value 0. It uses double declining balance method of depreciation for 2 years, then shifts to straight line depreciation at the beginning of the 3rd year. Now, compared with annual depreciation expense under the double declining balance method, the resulting annual depreciation expense in year 4 is higher or lower? Now, this is a good question. My recommended approach There is a shortcut also to use the formula to calculate depreciation for each specific year. But if you construct a table like this, this will help you to analyze each year separately, and constructing such a table is not a very challenging task. We have 4 years and the comparison is to be done in the 4th year. So we need individual numbers all these years, right? Or else you can calculate for 4th year directly. So this lay down working will help you see things more clearly. Now this is the asset. If you depreciate it using straight line method, but that has to be done at the start of year 3, first we will have to depreciate using double declining balance method. How do we calculate the double declining percentage? You take 2, divide 2 with the estimated life, which is 5, and multiply this fraction with 100, that is 40%. So your depreciation will be 40%. The cost of the asset is $200,000. The first year depreciation will be 40% of $200,000, that is $80,000. Next year depreciation will be simply 60% of the number. Don't calculate the net book value and then calculate 40% this. You can simply multiply 60% with 80,000. It will give you the depreciation in the second year. Depreciation for the third year will be 60% of 48. That will be 28,800. And depreciation for the third year will be just 60% of this number. That will be 17,280. This would have been the depreciation had we used DDM till the end of double declining method, till the end of the 4th year. Since we decided to switch to straight line method at the end of 2nd year, so from 3rd year we'll use straight line method. But for that we have to first calculate what is the value at the start of year 3. This is the total depreciation charge, 80 plus 48, 128. Right? So if you deduct 128 from $200,000, it means the remaining value that needs to be split equally over the next 2 years is 72. Or is it 3 years? Asset is for 3 years, 5. There are 5 years there. So it means you have to split this 72,000 in 3 equal parts, meaning thereby your straight line depreciation will be 24,000 in the first year, 24,000 in the second year, and 24,000 in the third year. Since we have to compare just the 4th year only, now we have these numbers in front of each other, and now we can give our opinion or our final result. Under straight line method, the 4th year depreciation will be 24,000. Under double declining balance method, the depreciation would have been 17,280, which clearly means straight line depreciation will be greater than the double declining balance method. So that gives you C to be the correct option, and the numbers support your result. An analyst in the finance department of Bouldo, a French corporation, is computing the amortization of a customer's list, an intangible asset for the fiscal year ended 31st December 2009. She gathers the following information about the asset: acquisition cost, acquisition date, expected residual value at the time of acquisition, 500 euros. The customer list is expected to result in extra sales for 3 years after acquisition. The present value of these expected extra sales exceeds the cost of the list, meaning thereby it's not impaired. If the analyst uses the straight line method to amortize the amount of accumulated amortization related to the customer list as of 31st December 2009. When did we acquire? January 2008, December 2008, 1 year, and December 2009, 2 years. Means we are talking about 2 years accumulated amortization. How do we calculate the straight line amortization? Cost 2.3 million euros, residual value 0.5 million, and it is to be split over 3 years. 2.3 less 0.5 means 1.8 million upon 3, that is 600,000 euros every year. Since we are talking about accumulated amortization for 2 years, so just multiply this with 2, that will give you 1.2 million. This is the balance in your accumulated amortization account against this customer list, which is an intangible asset. That makes B to be the correct option, and B it is. Next, question number 20th. A financial analyst is analyzing the amortization of a product patent acquired by Macati, an Italian corporation. He gathers the following information about the patent. Acquisition cost is given, acquisition date is given, patent expiration date is given, total plant capacity of patented product 40,000 units per year, Production patented product in the fiscal year ended 31st December 2009, just the end of the first year when the patent was acquired, 20,000 units. Expected production of patented product during the life of the product, this is 175 for the whole life of the product. Okay. Now, if the analyst uses the units of production method, the amortization expense on the patent for the fiscal year 2009 is closest to. Okay, this is what we have produced in the first year, and this is what is expected in total. Mind it, the denominator must be the total expected production multiplied by the depreciable base. What is depreciable base? Depreciable base is the acquisition cost or the original cost less expected residual value. Have we any residual value? No. So it means this is the depreciable base. 5.8 million is your depreciable base. So 20,000 upon 175,000 multiplied by 5.8 gives you a whole number 662,857. This is the amortization in the first year, as when we produce 20,000 units, it matches with your option B. A company acquires a patent with an expiration date in 6 years for 100 million yens. The company assumes that the patent will generate economic benefits that will decline over the time and decides to amortize the patent using the double declining balance method. The patent will last 6 years, and the method to depreciate or amortize is double declining balance method. The annual amortization expense in year 4. Let us first calculate the rate. 2 divided by the estimated life multiplied by 100, that gives you 33.33%. We have to calculate the depreciation for the 4th year. I recommend this approach because sometimes you may have to find something in between these years. It's not difficult. It's just simply you need to press keys and you'll get your result straight away. You don't need to write anything. So first, what will be the depreciation the first year? 100 million, that is the original cost, multiplied by 33.33%. That will give you the depreciation for the first year, that is 33.33 million. Next year will simply be multiplying this number with 66.6, because if the first year percentage multiplication 33.33, take this number and all the subsequent years depreciation can be calculated by 100 minus 33.33%. Sometimes this intermediate working is very helpful. So 66.6% will be multiplied with 30. You will get 33.33 million times 0.666. It will give you 22.22 million. Next year, multiply this percentage with 22.22 million. You will get 14814.813. And further, third year, multiply this number again with 0.66666. The amortization for the 4th year will be 14.814 with 0.666. It will give you 9.876532. I prefer this method because sometimes in between working is needed. Otherwise, we could calculate directly. We could calculate this number directly by multiplying 100 million with 1 minus 0.333 times 4. Could have been calculated, but this intermediate working was sometimes very helpful. Sometimes we have to work forward and backward, so this, it doesn't take much time, but intermediate working is essential. Sometimes we have to work through the workings within itself. So 9.876, that's 9.9. B is the right answer. Next question 22. A company is comparing straight line and double declining balance amortization methods for a non-renewable 6-year license acquired for 600,000 euros. The difference between the year 4 ending net book values, we need to find the ending net value difference using these two methods. So one side we have straight line method, on the other side we have double declining balance method. We need for the 4th year the difference between the book value. Since the asset is expected to last 6 years, so every year straight line depreciation will be $100,000. So it means the first year book value, I'm doing it in extended form. You can make your own shortcuts. This is the book value at the end of year 1, deducting 1,000 again. Book value at the end of year 2, 3, It can be done in shortcut. I just want to lay down the working so you know what happened. So this is the book value at the end of year 1, 2, 3. What I'm doing, I'm deducting $100,000 every year. 100,000 of 600,500. Deduct 100 again, and that's the book value at the end of 4 years. What will be the book value at the end of 4 years under double declining balance method? For that, we need to first calculate the percentage. You will divide 2 with the estimated life, multiply it with 100. That's going to be 33.33%. So the first year book value would be 66.666% because this is the depreciation, and remaining 100 minus 33.3, this will be the book value. So 66.66 million times 600,000 euros, it will give you 400,000. This is the book value in the first year. Multiply this number with again 0.666. It will give you 266.66. Working is laid down for clarity. You can do it in a short formula as well if you want to. Multiplying this again with 0.666 will give you 177,777. In the last year, multiplying this book value again with 0.6666 will give you 118,518. Difference between these two will be the difference in book values. Though this laid down working is good for understanding, and yes, we do have shortcuts as well, so you can use any method you want as long as you get the right answer. So the difference between the book values under straight line method and double declining balance method would be 81,482. And that's A. Maru SA, a Mexican corporation that follows IFRS, has selected or elected to use the revaluation model for its property, plant and equipment. One of Maru's machine was purchased for 2.5 million Mexican pesos at the beginning of the fiscal year ended 31st March 2010. The year started on 1st of April 2009, and the ending is given to us 31st March 2010. So remember, the acquisition date was 1st of April 2009. The fiscal year ending on 31st March 2010. As of 31st March 2010, the closing of the fiscal year, the machine has a fair value of 3 million Mexican pesos. This was the acquisition cost. This is the fair value at the end of the fiscal year. Should Maru show a profit for the revaluation of machine? No. We discussed a little while ago during our study of reading. Revaluation surplus under IFRS goes to equity. It is not profit. It's a part of equity. No. Because this revaluation is recorded directly in equity. So that makes B to be the correct option. An analyst is studying the impairment of manufacturing equipment of WLP Corporation, a UK-based corporation that follows IFRS. He gathers the following information about the equipment. We have been given the fair value, cost to sell, value in use, and net carrying amount. The amount of the impairment loss on WLP Corporation income statement related to this manufacturing equipment is closest to. We have to apply the IFRS impairment rule. What you compare your carrying value or book value with the recoverable amount, and the lower of this was taken as a new basis, and the difference would be the impairment. So what is recoverable amount? A recoverable amount is higher of the two things. First, value in use, and second is fair value minus cost to sell. Your carrying value or book value is given as 19.1 million pounds. Your value in use is given as 14.5 million pounds. Your fair value is given as 16.8 million pounds. Your cost to sell is 0.8 million pounds, which means the fair value minus cost to sell is 16 million pounds. And your value in use is 14.5. The higher of these is clearly 16 million. This 16 million is the recoverable amount. It will be compared with the carrying value. Since carrying value or book value is higher than the recoverable amount by 3.1 million, so this 3.1 million pounds would be the impairment loss. That makes B to be the correct option. Next, under IFRS, an impairment loss on property, plant and equipment is measured as excess of carrying amount or the book value over what? recoverable amount. We just saw that. So that makes B to be the correct option. A financial analyst at Beto SA is analyzing the results of the sale of a vehicle for 85,000, whatever the currency is, Argentino pesos, on 31st December 2009. The analyst compiles the following information about the vehicle. We need to find whether there was a loss or gain on disposal. To determine the gain or loss on disposal, we just have to compare two things: the net book value or the carrying value versus the disposal proceeds. Disposal proceeds have been given as 85,000 Argentino pesos. We need to calculate the net book value. For this, we have been given the detail. This is the original acquisition cost. This is the estimated salvage value. 100 minus 10, that is 900,000 pesos, 90,000 pesos. And since it will last for 9 years, it means yearly depreciation is 10,000 pesos. The asset has been used for how many years? It has been used for how many years? 1st January 7. When are you selling? December 31st 9. 2007, 8, 9. 3 years. It means 3 years depreciation will be 30,000. So what will be net book value? Original cost minus 30,000 accumulated depreciation. So net book value is $70,000. So an asset with a net book value of $70,000 is being disposed at $85,000, not dollars, Argentino peso. So the difference currency doesn't matter, the number do. So numbers means 15,000 gain on disposal. That makes B to be the correct option. Next, Crocos sells an intangible asset with historical acquisition cost of 12 million and an accumulated depreciation 2 million, which means the net book value was 12 minus 2, 10 million, and reports a loss on sale of 3.2. There is a loss on disposal, and this loss is 3.2 million euros. Which of the following amount is most likely the sale price of the asset or the disposal proceed? This is the net book value, and you sold it at a loss of 3. So what 3.2 million? So it means, what would I mean the disposal proceed, the difference between these two? 10 minus 3.2, it means the disposal proceeds would have been 6.8 million euros. And that's the reason there is a loss, because you sold for less an item that had a net book value of 10 million. So that makes A to be the correct option. The impairment of an intangible asset with limited lives affects what? When you impair an intangible asset, as usual, I will go for journal entry. That's what we accountants do. When asset is impaired, an intangible one, there are either of two entries made. Either we debit impairment loss and credit it to accumulated amortization. This is the first way. Or second, we can simply charge loss as impairment loss and reduce the asset itself, intangible asset. So either it's going to be loss versus accumulated depreciation or impairment loss versus the intangible asset itself. In both ways, this part goes to income statement as a loss, and this part, accumulated amortization or the intangible asset, they both go to the balance sheet, either as accumulated amortization or the intangible asset. So in both cases, income statement and balance sheets both are affected. So it says when impairment of intangible asset with finite life, how does it affect our financial statement? Balance sheet but not income statement, wrong. Income statement but not balance sheet, wrong. Both balance sheet and income statement as evidenced by these journal entries. So that makes C to be the correct option. The gain or loss on sale of long-lived asset to which the revaluation model has been applied is most likely calculated using sale proceeds less. When you want to compare whether there is a loss on disposal or gain on disposal, you compare your disposal proceeds with what? With net book value or the carrying value. And how do we calculate the carrying value? That is the original cost minus accumulated depreciation. So you compare your disposal proceeds with what? With the carrying amount or the net book value. That's A. According to IFRS, all of the following pieces of information about property, plant and equipment must be disclosed in a company's financial statements. Except for what? Useful life, yes, to be reported. Amount of disposal to be reported in our assets schedule. Acquisition dates, IFRS doesn't require such a disclosure. This is not one of the requirements. So except for this, useful lives, yes. The amount of disposal, yes. Next, according to IFRS, all of the following pieces of information about intangible assets must be disclosed in a company's financial statements and footnotes, except for what? Impairment losses, yes, required in the IFRS. Amortization rate, yes. But fair values are not to be reported unless you are using fair value model. IFRS do not require fair value of intangible assets to be disclosed. Next, 32. Which of the following is required financial statement disclosure for long-lived intangible assets under the US GAAP? Useful lives of the assets. Detail regarding useful lives of the assets, whether they are of limited life or unlimited life. This is required as per IFRS. There could be sometimes confusion because the requirement of both might be sometimes there might be some overlapping. So useful lives of the assets, intangibles, it is required under the IFRS. Reversal of impairment losses. Reversal of impairment losses is not permissible under the US GAAP. So this totally rules out option B. There would be a strikeout option in your CBT on your CFA level 1 exam. Whenever which option you find to be totally inappropriate, there will be an option. You will simply right click on the option. There will be a black line over the option, which means you will no longer will be focusing on this option because it's totally not considerable. This is called strikeout option. You can also highlight a particular part of the question which you find to be the key to the question. You can highlight, and this highlighting part will remain as long as you are on the system doing the test. So this is crossed out, not possible. So under the US GAAP, what we are required to do, estimated amortization expense for the next 5 fiscal year. This is the specific requirement under the US GAAP. Under the US GAAP, companies are required to disclose the estimated amortization expense for the next 5 years, explicitly required. Even we did not read this in the books, we might not remember this in the books, but once you're doing the questions, these things get onto your heads. They keep on hooked up, and you would know exactly that this was something we read in our questions. So where the theory fails you, or maybe you didn't remember, the questions will fix the ideas on your head. That's why I focus more on questions, because the things get fixed up on your mind through questions. Which of the following characteristics is most likely to differentiate investment property from property, plant and equipment? Investment property, property, plant and equipment. Which of these is the differentiating feature? It is intangible. This is not a differentiating feature. Investment property and property, plant and equipment, they can both be tangible, and they are mostly tangible. It is long-lived. Yes, investment property and property, plant and equipment, they are both long-lived. The difference is investment property earns rent, but property, plant and equipment, they are for business own use. This is the distinguishing feature, and that's why it's our right answer. If a company uses the fair value model to evaluate investment property, changes in the fair value of the asset are least likely to affect what? We discussed a little while ago. Fair value for investment property, any fair value gain and loss goes straight to your net income or to operating income, not to the other comprehensive income. Other comprehensive income shows 4 specific type of transactions: available for sale, debt or redeemable preferred stock, any gain and loss on remeasurement of available for sale, debt or preferred stock, it is shown in OCI. Second, foreign currency translation, gain and loss. Third, defined pension benefit plan, any gain and loss on the pension plan. And fourth, gain or loss on effective portion of cash flow hedge, that a fair value hedge. So these are the 4 specific transactions reported in OCI. This is not the one reported there. So that is least likely. C is least likely. Investment property is most likely. We just discussed investment property can have one of these 3 categories. Either it is treated as investment property in its own right, or it is considered as a property, plant and equipment, or it's a part of your inventory where you sell these properties. So investment property, property, plant and equipment. So you can switch from this to this to this, and we discussed how the gain and loss would be discussed. We read it in the reading. So investment property is most likely earns rent. Held for resale, this would be inventory. Let us do it again. These three categories, and I will link these because the things were messy. We have investment property, property, plant and equipment, and inventory. Let us link these options one by one. Investment property is most likely to do what? Earn rent. Earned rent would be investment property. Held for resale, it will be inventory. And used to produce goods and service, that will be property, plant and equipment. So the one that perfectly matches is the one that earns rent, investment property. Held for resale, inventory. Used in production for goods and services, property, plant and equipment. So perfectly fitting with option A, and A it is. A company is most likely to use a fair value model for some investment property and a cost model for other investment property. We just discussed there are three categories: investment property, used for the business itself, property, plant and equipment, or inventory. So we can't cherry pick. No such cherry picking is allowed. Some investment property as fair value, rest of them at cost. No. Change from fair value model when transactions on comparable properties become less frequent. This is not a valid reason to transfer one property to another. These are the three categories specifically defined, which we discussed in a table. Change from fair value model, yes, when the company transfers investment property to property, plant and equipment. Change from fair value model. So yes, that is one of the transitions from fair value model to the property, plant and equipment model, that is cost or revaluation model. This was one of the transitions in the investment property, and that is the right answer. Under the revaluation model for property, plant and equipment and the fair value model of property, plant and investment property, two things given simultaneously. Under the revaluation model of PPE and fair value model of investment property, these two simultaneously. Fair value of the asset must be able to be measured reliably. It is true both for fair value model and revaluation model. Fair value of the assets must be able to be measured reliably. This option is the one that is true for property, plant and equipment, revaluation model. For PPE we use revaluation model, and for investment property we use fair value model. So this option A fits well with both of these. B, net income is affected by all changes in fair value of the assets. This is only true for fair value model in case of investment property, but not for property, plant and equipment. If you remember, the property, plant and equipment revaluation gain and loss, sometimes it goes to equity, sometimes to income, but not always. This is true for one, but not for the other. Net income is never affected if the assets increases in value from its carrying amount. It does. We discussed it in the proper schedule that it can affect your incomes if previously you wrote off a revaluation loss, but this time now the asset has gone up in revaluation, so the prior year loss might be reversed in the net income. So net income can be affected. So this is wrong too. So the correct option only is A, that is good for both fair value as well as the revaluation model. Question 38. Under IFRS, what must be disclosed under the cost model of valuation for investment property? Under IFRS, what must be disclosed? Useful lives. Under IFRS, when you use cost model, investment properties useful life must be disclosed, one of the requirements, even if you haven't read in theory. So the questions will fill the gaps. That's what I say when many things might be missed, because we read a very little theory, very little text. So those holes, those gapping holes will be filled through questions. When you do questions repeatedly, you won't do question once. I never recommend student doing question once. Twice, thrice, 4 times, as much time as it takes to fix the idea. Repetition on questions is helpful. That will fill the knowledge gaps that might have been left by less reading. So once you do this question, the idea will get fixed. Then it says the method the method for determining the fair value. So IFRS specifically requires the useful life of investment property to be disclosed. The method for determining fair value, reconciliation between beginning and ending carrying amount of investment property, the method of determining fair value as well as reconciliation given in B and C. It is required disclosure under fair value method, not cost model. Cost model requires useful life, and these two requirements under the IFRS are for fair value model. If you didn't know this, reading this information, the explanation given in the questions answer will help you fix up the idea on your head. A is the right answer. Next, a bigger question. 39 to 42 questions are related to this information. Melanie Hart, CFA, is a transportation analyst. Hart has been asked to write a research report on Altai Mountain Rail Company. Like other companies in the railroad industry, AMRC's operations are capital intensive, more use of machinery with significant investments in such long-lived intangible assets as property, plant and equipment. Capital intensive. In November of 2008, AMRC boards of directors hired a new team to manage the company. Okay. In reviewing the company's 2009 annual report, Hart is concerned about some of the accounting choices that the new management has made. These choices differ from those of the previous management and from common industry practice. What are these? Hart has highlighted the following statement from the company's annual report. 1. In 2009, AMRC spent significant amount on track replacement and similar improvements. It could have been capitalized. AMRC expensed rather than capitalizing a significant portion of these expenditures. Now, this is one of the things he found unusual, because this is not normally what was happening previously, or this is not the industry standard. Capitalization of a major investment has been expensed rather than capitalizing it. Could have been capitalized. This is something we'll discuss in questions. Next, AMRC uses straight line method of depreciation for both financial and tax reporting purposes to account for plant and equipment. Straight line method. Okay, this is the second point, second statement. Third, in 2009, AMRC recognized an impairment loss of 50 million on fleet of locomotives. The impairment loss was reported as other income, of course as a negative number, in the income statement and reduced the carrying amount of the assets on the balance sheet. So it was reported as other income, so it should be shown here as a negative. Otherwise, income has shown as a negative number here. Okay. Exhibit 1 and 2 contain AMRC's consolidated income statement and balance sheet. AMRC prepares its financial statement in accordance with the International Financial Reporting Standard IFRS. This is your consolidated statement of income, and this is the consolidated balance sheet. Comparatives are given as well as the common size is given as well. See, common size, vertical, and income statement as well as vertical side. Okay. What's the first question? With respect to statement 1, which of the following is most likely effect of the management decision to expense rather than capitalize these expenditures? Why did they expense a large amount instead of capitalize? It could have been capitalized. I think the number hasn't been. So the amount that has been expensed is not given separately. So we need to know reason. Why did they do that? This is the first question. 2009 net profit margin is higher than if the expenditure had been capitalized. The net profit margin for 2009, since you have expensed it, so your 2009 net income is lower. Not correct, because you have expensed this rather than capitalizing it. 2000 net profit margin is not higher, it is lower than the capitalization. This is a wrong option. B. 2009 total assets turnover is lower than if the expenditure had been capitalized. 2009 assets turnover would be higher. Why? Because no capitalization expense has been made. lower assets. It was not capitalized. So when you have lower assets, the denominator will be larger because assets turnover is sales upon average total assets. Since it was not capitalized, rather it was expense, so your average total assets are lower. Having a lower denominator means your assets turnover will be higher, not lower. Wrong. Yes, future profit growth will be higher than if the expenditure had been capitalized. This makes sense. Since it is expense now, so no more depreciation in the future. So future profitability would be higher. This is the right option. C is the correct option. Next, with respect to statement 2, what would be the most likely effect on 2010 if AMRC were to switch to the accelerated depreciation method for both financial and tax purpose? We don't need to look at the information. We know what will result if we use accelerated depreciation method. If you use accelerated depreciation method, your depreciation would be higher. So resultantly, your net profit would be lower. Net profit margin would increase? No, it would decrease. If you use accelerated depreciation method, your assets turnover, sales upon average total assets. Since you charge higher depreciation, the net book value of the assets will fall. So assets turnover would increase, not decrease. Total assets turnover would increase because of accelerated depreciation. So it means it has to be C. Why? Let's see. Cash flow from operating activities would increase. That makes sense. Since when you charge accelerated depreciation, higher depreciation charge is added to come at the cash flow from operations. So higher cash flow from operating activities because of higher depreciation charge. That makes sense. That is the right answer. C is the correct option. With respect to statement 3, what is the most likely effect of impairment loss? Impairment loss was reported in other incomes as a negative number, as you can see here. So what is most likely effect of this impairment loss? This is your question number 41. It says net income in prior year to 2019 was likely understated. How come the prior year income statement be understated? Cost was only expensed in 2009. How does it affect the prior year earnings? This is a ridiculous response. Must be crossed out straight away. Understated or overstated in the prior year, totally irrelevant. Net profit margins in the years after 2009 will likely exceed 2009 net profit. That makes sense. Since you have expensed such a large amount, you have charged impairment loss. In the future, there will be no such losses because there will be no depreciation in later years. You have expensed it as the cost has been expensed in 2009. So it's a correct statement. Future profitability will be higher. This is a correct statement. Why not C? Cash flow from operating activities in 2009 was likely lower due to impairment loss. That is not true. Cash flow from operations would be higher because CFO, that CFI, that is cash flow from investment, it would be lower. Cash flow from operating would be higher, not lower. Wrong. So that makes B to be the correct option. This is the last part to this question. Based on Exhibit 1 and 2, the best estimate of the average remaining useful life of the company's plant and equipment. Average remaining life. There was a set of 3 formulas. One of them was to calculate the average remaining life, and the formula we will write there where it is needed, where we will have the numbers, and I think here we have the numbers. So the formula is net property, plant and equipment divided by depreciation expense. That would be net property, plant and equipment. This will be depreciated over the future. Divided with the annual depreciation expense will give you the estimated remaining life. That's common sense. We can construct the formula just by thinking a little. So look at this. Total assets, property, plant and equipment, 6.7 million. Out of this, 700 million represents land, which is not depreciated. So remove this from the number, take 6,000 and from this deduct accumulated depreciation 1850. This will give you cost minus accumulated net property, plant and equipment. And you need to divide it with depreciation expense. And here is your depreciation expense, 200 million or whatever the number is. So 6,000 less 1850 divided by 200 should give you 20.75 years. This is the average life of the assets remaining, and this should be the result of your 20.75. A. And A is the right answer.